So let's start from the top. What we're going to talk about today is the 1031 exchange rules. I'm going to put it in as plain English as humanly possible. As realtors, right, we have a fiduciary responsibility to make sure that our clients have the best advice and get the best options to serve, here it comes, their financial interests. We at Keystone represent a property consulting firm mentality. We understand that we come to the table understanding fact. We come to the table with a wide breadth of experience that are going to help people not only buy their first time home or sell a home and buy the next home, but truly how to teach and practice the investment strategies behind owning what could be the most expensive investment that any of our clients make, especially so keeping as much money in their pocket as possible. So when it comes to saving money on capital gains from selling a property or from selling an investment property, 1031 exchange is almost always going to be in their best interest. If you want to work with investors particularly, but any home buyer qualifies for these things if they have more than one home, you need to know how to explain the complexities of a 1031 exchange and do it in plain English. Now, I'm going to throw my proviso in on top of all of this. We're not lawyers. We're not accountants. So stay in your lane, folks. We want to make sure that everybody understands we are real estate professionals. And in our industry, we are the next level of that. We run a consultancy. So we want to make absolutely sure that anything that we represent can be fact checked or that we're leaving a handout to be able to support anything that we're stating. If you want to work with these types of folks that are money minded, you've got to know how to be able to explain some of these complexities. So to make your job easier, I took the time and put this together with some simple 1031 exchange rules, a cheat sheet, if you will, that's going to help save your clients money, especially during tax time. There is a lot to digest on the 1031 problem. So if you're in a rush, you can simply rerun this recording later on and listen to it over and over again until it becomes logical for you. So let's get basic. What is a 1031 exchange and why is it important? What it refers to is the 1031 of the Internal Revenue Code. This allows a property to be exchanged. Now, let's be clear. A like-kind property gives you the benefit in a 1031 exchange, so it defers any taxes that would normally be paid on a capital gain from the sale of a property. I'm going to say that again. The benefit of a 1031 exchange, basic compliance. It defers the taxes that would normally be paid anytime you had capital gains on the sale of a property. While everybody likes to save money, right? And certainly, how can I defer those monies instead of giving it directly to the IRS and capitalize on using that money as an alternate investment? When selling your home and buying a new one, a 1031 exchange is only going to be allowed on an investment property type. So if you're not using investor properties yet, or if your clients haven't gone to that next level and they haven't bought multiple properties, just take your time, work with them, have these conversations so that they understand that it's a good opportunity for them to think about it in the future. A lot of the things that keep people from going from homeowner to investor is quite simply misunderstanding or lack of understanding completely on how they're going to be able to energize this investment to make money for their long-term financial strategy. So let's talk about how they work and let's talk about what the process is. So the 1031 exchange process is where the person sells one investment property, purchases another very similar, a like-kind property or multiple properties, right, of equal or greater value than the property that was sold. The first property, the one your client is selling, is known as the relinquished property, the property that they're getting rid of, right? This is the like-kind property that they want to replace. The like-kind property that they're going to purchase is called the replacement property. So the relinquished property is the one they're getting rid of, while the replacement property is the one they're replacing it with. Like-kind meaning property for property. The proceeds from the sale may not be received by the seller. So basically, the money cannot hit their bank account. Instead, the money from the sale of their first investment property must be transferred to a qualified intermediary, known as a QI in the business. But this QI holds those funds until a replacement property is identified and purchased. Now, this is really tricky. This is the part where a lot of people screw up. I'm going to sell a property. I'll get my money when I sell my property, and then I'm going to take that money and use it to invest in the next one. Not that simple. You need to know in advance that that's your plan, because that money, you can certainly use the title company if you're using one that's got these reputable standards, needs to be held in a special account by a specialty person or specialty business that has this type of opportunity for you to be able to move monies from one to the other. When all the proceeds from the sale of that relinquished property are used for the purchase of the replacement property, that sale is considered an exchange. And at that point, is not a taxable event. The advantage to your client is going to be that they will not have to pay capital gains taxes on the uptick in the value of the property that they sold. So they sold it, they bought it for a certain price. They hopefully, if they bought in the state of Florida, chances are pretty strong, but hopefully they made money at it. If they took all of those funds and cycled it into the new investment, then there is no tax penalty or tax qualifier that is going to hit them in the pocketbook. So when taxes must be paid on 1031 exchanges is the next step down the line. Any proceeds from the sale of the relinquished property, the property we got rid of, is not used to purchase the replacement property, is called a boot, right? So any money that you didn't use, if you sold a property for $600,000, you didn't roll all that money into the next property. The next property you bought was only $550. The money between the two, the delta of the lesser amount, that $50,000 in this example, would be considered boot, and that is subject to taxation as long as it was part of that capital gains percentage. And again, I realize this can get really complicated, so I'm trying to keep it as simple as possible. All accountants are very well versed in this. So if you're using a good one, and you should be, if you're going to be a property investor, they will understand how to do this. But the most important thing is that you're doing it in advance. A lot of people think that they can just deal with this later, or I've got a year to buy a property or whatever. That doesn't mean that they get to hold on to or use that money while they're doing it. So we have to make sure that they're following the right thing. It is super important to understand that investors that want to use the property sale to buy lesser priced properties absolutely must pay the taxation on the delta, the minimized delta between those two transfers. The smartest thing to do is for them to roll every penny into the next property, ultimately building their investment strategy one investment at a time, always buying a more expensive property. If they have to pull out of that system, they need to be ready to only pay taxes on which amount they did not invest in. So let me just kind of walk through an example, make sure everybody understands, right? A family has a single family investment, right here in Tampa. They want to sell their Tampa property, purchase 2 duplexes in Sarasota. Perfectly acceptable. The home in Tampa was valued at $600,000, had an outstanding mortgage balance of $300,000, meaning they still owed $300,000 on that property. After the sale, obviously, the first thing that happens is they pay off the balance of that mortgage. In addition to the cost of closing the sale, $48,000 there, that's going to leave them with $252,000. Ultimately, $600,000 property was sold. The title company paid off everybody, paid all their fees, did all of their closing requirements, etc., leaving them with, and let's just make the number simple, $250,000 balance. Since the proceeds from that sale cannot be given to the seller cannot ever have possession of that differential. They must find a qualified intermediary. Hopefully the title company is already qualified, so that's easy. They will simply hold it in an escrow account until those funds can be used to replace that investment property, like style, like satisfaction, like type of property. In this case, the 2 duplexes that we're going to buy in Sarasota is what we're going to use it for. So the qualified intermediary will complete the necessary paperwork at that time. So the title company and the IRS will have everything that they need to show that the full transaction has been completed correctly. Once the relinquished property is complete, the seller will identify those replacement or like-kind properties within 45 days of the sale. Closing of selling the first house, they've got 45 days to identify what will be the replacement property. Sellers exchanging that Tampa property for the 2 properties that they found in Sarasota or whatever. As such, the desired Sarasota properties now becomes, they're like-kind transactions, they become eligible for the 1031 exchange. They go through the same financing processes. If they want to buy cash or they want to do any of that, that's totally up to them. But all of those remaining monies that were there for the investment must now be reinvested in the new properties. So that's it. Replacement of value. It is very simple. If they want to avoid the taxation on the capital gains, then 100% of the value of the relinquished property must be replaced by the property that they purchase next. And make sure that you're using my vocabulary correctly. The new property, the replacement property, must be identified under contract within 45 days. It doesn't mean that it's got to be closed in 45 days, but on paper, it needs to be identified in a contract somewhere. In that example, right, the seller identified theirs early. They made sure that they got into the purchase contract for the new properties in Sarasota, and they protected everything through the same title company or the same intermediary. That same person makes sure that that entire $250,000, I know it was $252, but that whole $250,000 from the sale of the Tampa home goes all the way into purchasing the new one, that money. Now, it may take them more than that. Obviously, there's going to be some financing involved. If they're buying multiple properties with that same thing, then it can get complicated, but they want to still make sure that if you're using a qualified title company and an intermediary to move the funds, that all the funds go in there, so there is no issues. So, quick review. The 1031 exchange rules in plain English. Both properties must be titled under the same person's name. Second investment property must replace the value of the first. The purchased properties must replace the debt of the first property. It must use all the proceeds from the sale of the first one, must be invested into the second one. They must be like-kind properties. We can go into that in as much detail as possible, but it's simple for you to realize if you're buying a home, if you're buying an investment property that's single-family residence, you need to replace it with one or more other single-family residences. And I can't state that enough. If you're an investor and you're looking to buy multiple properties and expand your portfolio, that means multiple investment properties. If you take your investment funds and roll it from a single-family residence into a duplex or a fourplex or multiple lots in the same transaction, fine, not an issue. Identified in